All right, we'll go through some of these problems here to give you a little bit of a brief explanation to help you a little bit with the understanding some of the concepts that were discussed in preparation for the exam tomorrow. Now, the question here is basically to define some of these elements here and talk a little bit about them in context of the consolidation method. Okay, so the question is, what would be included as part of the consolidated totals? Well, with Part A, what they're saying is they want you to, what would happen with the equipment? Well, basically, it's the book value of the parent's equipment plus the fair market value of the subsidiary's equipment less whatever amortization might have been taken on the equipment of that the parent is bringing into its financial statements. Okay, the investment of the parent is always eliminated, and it's eliminated against the equity of the subsidiary. And also there would be some other adjustments to the whatever fair market value adjustments might have been made for the assets that were acquired at the time of acquisition. Okay, dividends declared. Well, the only dividends declared that are reported on the consolidated financial statements would be the dividends of the parent. The dividends declared of the subsidiary are eliminated and they don't go forward to the consolidated financial statements. Now, the elimination for dividends is a little bit different in a sense that, remember, dividends declared is a type of contra equity accounts. It really has a debit balance. So to get rid of dividends declared, you're going to make a credit entry. The debit entry is to the investment account, and that's netted against the other adjustments that are made to eliminate the investment account. D is asking about goodwill. Well, goodwill is always going to be the difference between what you pay for something and the book value of the assets acquired. Now, that excess is not all goodwill necessarily. The first iteration would be to go through and see if there are any fair market values that need to be adjusted. After those adjustments are made, if there's anything essentially left over, then that's attributed to goodwill. Goodwill is never amortized. Rather, on an annual basis, goodwill is examined to see if any of it needs to be declared to be impaired. Then goodwill would be written down accordingly. E is looking at revenues. Well, revenues are simply added across, both the parent and the subsidiary. No adjustment is made to revenues, are simply added across. Expenses of the consolidated entry are like revenues. They're the sum of both the parent's expenses and the subsidiary's expenses, plus whatever amortization would have taken place because of the adjustment to fair market value of the subsidiary's assets. Now, that adjustment, that amortization could be an additional debit entry to essentially increase expenses. And as one of the problems demonstrated, if you have to write down an asset, then you could end up with a credit entry, sort of a negative expense that would adjust the expenses downward. Common stock, only the parent. The equity of the subsidiary is eliminated, and actually one of the first entries to eliminate the investment account. Net income is going to be the net income of the parent, and that will include the all of the adjustments that are made. So if taking the consolidated revenues minus the consolidated expenses will give you the consolidated net income, which will always equal the parent's net income. Okay. The net income that the parent is going to pick up is a result of the subsidiary's revenues and expenses. So everything that's taking place in the subsidiary in terms of operations, excuse me, for revenues and expenses are recognized in the net income of the subsidiary. The parent picks up this 100% of that amount. That's reflected in the investment account, and likewise it's reflected in the additional earnings that the parent will record on its own financial statements. So in a sense, the equity method parallels consolidation, because when consolidation is finished, as we talked about up here, the net income of the parent will always equal the net income of the subsidiary. And actually, excuse me, I said that wrong. The net income of the parent will equal the net income that's determined under consolidation, which would include both the parent and the subsidiary. Okay, what they're getting at in number 4 here is, remember that throughout the year, if you go back and look at the example, that the parent will recognize its portion of net income. In this case, let's say, excuse me, 100% of whatever the net income might be, less whatever dividends were paid. Now, in addition to what the parent picks up in terms of income, the parent throughout the year on its investment account under the equity method will also recognize as a reduction in that investment account the amount of the amortization that takes place because of the adjustment to fair market value of the sub's assets. Now, under consolidation, that is eliminated. And rather than adjusting simply the investment account, that amortization is added to the total expenses. So it's reflected in the consolidated financial statements of both the parent and the subsidiary. Okay, number 7 is a pretty straightforward problem, so I'm not going to say a whole lot more about it, but suffice it to say that the ending balance in the investment account is the original consideration, what was paid for it, plus whatever is accrued in terms of subs net income, excuse me, less whatever dividends were declared, okay, less whatever periodic amortization because of the adjustment that is made to make sure that the assets that are acquired from the sub are stated at their fair market value. Okay, so now we'll take a look at the problems. We'll kind of go through here item by item, 1 through 14. Now the first one is basically, why would a company use the initial valuation method? Now on the exam, you're not going to need to know how to do this. We're going to confine ourselves to the equity method. But the initial valuation method is chosen by companies simply because of its simplicity, that the company will list the investment as cost, and it remains at that, and then dividends are simply reported as income. Now, remember that this is allowed under GAAP for the parent's own financial reporting. When the parent and subsidiary are consolidated, then you must go to the rules that they talked about in the chapter for consolidation. Okay, problem number 2 is very similar to what we discussed before. What would be a reason why companies may choose to use the equity method, although it is a little bit more complicated? Well, simply because the parent's financial statements will more or less reflect everything that's taking place in the equity. And that is that as they say, the parents, or the consolidated totals, both in terms of assets and in terms of income. Now the recognition, for number 3, the recognition of impairment loss is a little bit more complicated than what's alluded to. So I don't want to make this really too overly onerous for you, but pages 110 to 113 has some discussion of that. But basically, in order to for impairment to kick in, particularly for goodwill, then both the fair value, as I say in answer A, the reporting unit's fair value has to have gone down, as well as the associated goodwill. Generally, this is because of either internal events to the company or external events that are having an impact on the operations of the company. Okay, now number 4 is one of those you have to be kind of careful of, that you feel comfortable recognizing that some information is relevant, some is not relevant. So the question is, what is the equipment balance in the consolidated financial statements? Well, generally, equipment will be listed at the book value of the parent, plus the book value of the subsidiary, plus whatever fair market value adjustment was made at the inception, that is when the sub was acquired, less any sort of amortization that took place. So if you take the 294,000, that's the book value of PAR, the parent's equipment. 190,400 is the book value of the Kimmel, that is the subsidiaries, which gives you a total of $484,400. Less the amount of the adjustment that was made, which is $128,400. Then the $128,000 is being reduced each year over 10 years. So at the end of 3 years, you would need a total reduction of that amount of $38,400. So taking the 294 plus 190,400 gives you 484,400, less the 128,000, plus 128,400. I'm sorry, plus 128,000 gives you 612,400. Then the 128,000 divided by 10 gives you 12,800. If you multiply it times 3, it gives you 38,400. Subtract that, and you end up with the answer of A, 474,000. All right. Now, number 5 is one of those you just have to be very confident in what you're doing. How the parent handles the accounting for its investment has absolutely no impact when it comes to creating consolidated financial statements. So whether you use the equity method for the investment, the partial equity, or as they talk about the initial valuation, it makes absolutely no difference. Consolidation rules are very specific that you would basically come up with the same amount of assets at that point, regardless of the method that the parent chooses to account for its investment. Okay, the question for number 6, what happens if you're buying several different companies, or I'm buying Acme Corporation, that's become my subsidiary, but Acme is made up of, let's say, 3 different corporations itself. Well, GAAP says that whatever goodwill would be recognized needs to be apportioned amongst those subsidiaries. And so for sub A, B, and C, I will apportion a certain amount of goodwill. Now, if, let's say, for example, subsidiary B of Acme Corporation loses value, then we look at the answer B. Goodwill is impaired if the carrying amount for goodwill exceeds its implied value. So we don't have to write down all the goodwill, but rather whatever goodwill might be associated with that particular part of the subsidiary. All right, number 7. If there are no restrictions in terms of life, such as would be the case with goodwill, often with trademarks, then it's considered to have an indefinite life, not infinite, but an indefinite life. Indefinite in the sense that it will be written down. Eventually, all assets will be impaired. They do lose value. The difference is with goodwill and trademarks, that time element is very uncertain. So if that's the case, then annually the asset needs to be tested for impairment, and if impairment exists, then it would be written down. Okay, when there is a contingency that's going to be paid to the owners, let's say, of the subsidiary, regardless of the method of payment, then in fact, really what that does, it increases the purchase price. And you might say, because you took on the contingency, that it in fact, if it increases the purchase price, it really increases whatever goodwill would be recognized as a result of the acquisition. Okay, so number 9 is getting at what is the net income that would be reported under consolidation for Phoenix and Sedona? Well, basically, what you would do is to the easiest way I would argue is to look at what would be the consolidated revenues, what would be the consolidated expenses, okay? Now, the 580 is a little bit overstated in the sense that you also need to go back and look with respect to the consolidation of Phoenix and Sedona, was that there were 2 specific assets that were understated. So one asset, namely the customer list, was understated by $80,000. And so that's going to be depreciated over 8 years or amount of $10,000 per year. Likewise, there was a customer list that had a value that Phoenix was willing to pay of 100,000 that you believe has a useful life of 4 years or 25. So the 25 plus 3 gives you 35,000. Add that to the amount of here, then that would give you the 203,000. Now, let me actually put this a little bit differently. That if you take the consolidated revenues, that's equal to 783. The consolidated expenses, in fact, really equal $545,000. Now, if you take 783, subtract 545 from that, you're left with 238. Then you also have to factor in that adjustment of $35,000 for the two assets that were written up to fair market value. The equipment that was written up by 80,000 being amortized over 10 years, and a customer list written up by 100,000 being amortized over 4 years gives you that adjustment. So the amount that you end up with here is a 203,000. Okay, so that is simply looking at, and maybe perhaps is the easiest way to do that. Now the other solution is, arguably a little bit easier, and that is simply look to the parent's net income. And whatever the parent's net income is by definition going to be the consolidated net income. So Phoenix had revenues of 498, their expenses were 350, kind of gives you the amount of 148. Pick up the amount of, because there was the $55,000 of net income from Sedona that would be added to it. So the consolidated net income here would be $203,000. Now, one clarification, the equity income. Okay, if you take the amount of the difference here, 498 minus 350 gives you 148. Now, in fact, Sedona really had $90,000 of net income. Okay. However, if you subtract out the amount of amortization that's associated with that, 90 minus 35 gives you the net amount of 55,000. So 55,000 represents, on the positive side, the net income coming in to that would increase the investment account and increase the earnings. But at the same time, without the 35,000 is the total amortization for the two specific assets. And so the net amount would be to increase the investment and to increase the earnings of Phoenix. Okay, consolidated retained earnings, very simple, always going to be the consolidated retained earnings will be the same as Phoenix retained earnings. And at the end of 2015, Phoenix is reporting 250,000. Well, that would be the consolidated retained earnings. Okay, number 11. Now we identified the fact that the customer list had a value of 100,000. Now the customer list was developed by Sedona, so it really can't recognize it as an asset. But since Phoenix purchased this and is attributing a significant portion of the excess over book value to that, then at the time that of the acquisition, they're assigning $100,000. Now remember, this has a 4-year life. And at the time of consolidation that we're looking at, 3 years have elapsed. So going into the next year, only 1/4 or 25,000 of this amount would remain. Okay. 12 is a little bit of a challenging problem. But remember, at the time of acquisition, that contingency, whatever it was, okay, was included as both part of the purchase price and, let's say it was $50,000. So that's going to be added to the purchase price. And since they're issuing stock over and above the par value of it, the assumption is that contingency, namely, in our case, hypothetically $50,000, would be included as part of the paid in excess account. Now, in this case, okay, at the time of the adjustment, we don't know specifically what the fair market value of the stock is, but let's assume, obviously, that it's less than $23. So whatever that is that they're going to make up that difference. And so in a sense, since we can't change the investment account, that's locked in as an asset. You can't really do that. You made your best guess at the time of acquisition. So any adjustment is really left in the paid in excess account. So what you would do is to debit the paid in excess account for the total amount of the stock issuance, the 3,000 shares times whatever the existing market value is, and then that would be taken out of the paid in excess account, and then would be placed into the common stock, $3,000 or 3,000 shares at $10 or 30,000, and then the difference would go into the paid in excess account. So to a certain extent, it's sort of a lot of the paid in excess will stay there, but some of the paid in excess will end up as being capitalized under common stock. All right, push-down accounting is only recognized or is only done by the subsidiary. And push-down accounting is, again, an example of substance over form. And the idea behind push-down accounting is that the subsidiary should recognize its assets at the same amount, the same value as does the parent. Since the parent recognized that the assets perhaps were undervalued, then they're making the adjustment via the consolidation process. And then likewise, the subsidiary should recognize that too within its own books. Now, the push-down accounting is only used by the subsidiary, not by the parent, but by the subsidiary to account for its assets. Okay. Regardless of whether the sub is using push-down accounting or not, the assets would be shown at essentially the parent's book value of the assets plus the book value of the asset of the sub plus whatever adjustment to fair market value. Since the sub assets were understated, in this case by the 105,000, under push-down accounting, the subsidiary is allowed to essentially write those up to 441,500. So the consolidated total is going to be 871,500, which is the book value for Crawford, that is the parent, plus that push-down amount, namely 441,500. If the subsidiary had not used push-down accounting, you would have the 430 book value of Crawford, the 336,500 by the subsidiary, plus the adjustment of 105,000. In either version, you come to the total amount, namely 441,500, and total 871,500.